Last Thursday, the People Bank of China cut rates for the second time in a month, fueling concerns that there is more trouble ahead for its economy. Joining me today to discuss his insights at the start of another busy week for China is Ian Stannard, Head of European FX Strategy at Morgan Stanley. Now Ian, the PPI indices come in at 2.2 for June, hitting a 29-week low. What effects are you thinking this, along with the GDP figures due at the end of the week, will have on the market?
Certainly the data coming from China has continued to come in on the weak side of market expectations, which has been generating some broader concerns with regards to the global picture, and this is having an impact onto currency markets with regards to risk appetite. So the higher beta currencies, and particularly the commodity currencies, are likely to come under pressure as a result of the weakening data which we see coming from China. So overall, I think we are likely to see the market remaining cautious, looking for further weakness, and particularly as we head into the GDP data at the end of this week from China. If we see a weak number here, this will likely hit the commodity currencies further, and we would highlight the vulnerability of the Australian dollar within this environment. The Australian dollar has been very closely linked to the performance of the Chinese economy, and if we continue to see the weakness coming from China, that is going to put the Australian dollar under further pressure. So overall, I think the Australian dollar looks to be the currency which is most vulnerable to the current data weakness coming from China.
The Chinese Premier has called for the government to preset and fine-tune its policies in a more aggressive manner, using fiscal and monetary tools to offset the economic slowdown as much as possible. What sort of effect do you think this more targeted approach will have, not only in terms of China, but of the global economy as well?
Very much a feature of the approach currently being taken. So rather than the broad brush approach that we've seen in the past, the Chinese authorities do seem to be taking a far more targeted approach, targeting parts of the economy which they see as needing far further stimulus. So I think that is going to continue to be the approach taken, and I think this is going to be consistent with the rebalancing process within China. But at the same time, this does suggest that any stimulus being provided is going to be more aimed at the domestic picture with regards to China, and is unlikely to spill over into providing some broader support for the global economy, and hence that's one of the reasons why I believe that the current policy stimulus being provided will not provide a broader support to global risk appetite, and this will then continue to leave the high beta currencies vulnerable in this environment.
Some politicians have mentioned that the country's currency, especially against the dollar, is overvalued and that action will be taken to address it. What are your thoughts on this?
I think the interesting developments with regards to the Chinese currency is the fact that we've seen quite a significant change in trend taking place over the past few months. Now we've seen the dollar yuan rate bottom out during the first half of the year, and in fact dollar yuan now starting to move higher. I think we need to look at this within the context of the reserve data coming from China. We need to watch that very closely. If we start to see Chinese reserves remaining stable or even falling within this environment, that would be a very clear indication that the recent weakening of the yuan is in fact a function of private investor outflows from China as part of a broader a risk aversion move. So that, I think, needs to be watched very carefully. So we'll be looking at the movements in the yuan as very much within the context of the reserve data. I think that will give a very clear indication of whether this move is being driven by private outflows as part of a broader risk aversion move now developing in global currency markets.
And finally, there is an increasingly divergent debate as to whether China will face a hard as opposed to a soft landing. In your opinion, what does the future have in store for the Chinese economy?
We continue to believe that the Chinese economy is heading for a soft landing over the course of the next year, and then for the policy measures to start to take effect, and for the Chinese economy to start to appreciate over and to reaccelerate over the course of the coming years. So we're still very positive on the Chinese economy over the medium term, although we are likely to be in a soft patch over the next couple of quarters.
Well, that's all from Ian and myself for the moment, but the Dukascopy TV team will be bringing interviews throughout the week, so do stay tuned.